The market is currently closed. Rezolve AI plc, trading under the ticker RZLV, finished the session on Friday, January 23, 2026, at an official closing price of 3.14. While most traders are fixated on the nearly 10% slide during that final session of the week, there is a much more significant data point hiding in the shadows of the recent capital raise that many retail investors are completely overlooking. On January 21, the company closed an oversubscribed $250 million registered direct financing round. What makes this striking is not just the size of the capital infusion relative to the market cap, but the fact that it was anchored by returning institutional investors who already had a front-row seat to the volatility of the last 6 months. In a market where small-cap technology firms are often left begging for liquidity, Rezolve managed to pull in $250 million in a single week. This creates a massive disconnect between the price action on your screen and the institutional conviction happening behind the scenes. The common belief right now among the retail crowd is that Rezolve is just another post-SPAC casualty caught in a cycle of endless dilution. You see this narrative all over the forums and social media feeds. The logic seems simple enough on the surface. The company issued 62.5 million new shares at $4 each, and the stock immediately cratered toward the $3 mark. To the average observer, this looks like a classic case of the market rejecting a dilutive event. There is a feeling that the leadership team is simply using new shares to keep the lights on, while original investors search for an exit. This skepticism is fueled by the stock's history, having traded as high as $8.45 within the last 52 weeks before this recent downward spiral. Many feel that the promises of high growth are just a distraction from a balance sheet that has historically struggled with operational efficiency. However, if you challenge that belief and look at the actual mechanics of the recent price action, a more complex picture emerges. The massive 23% drop on January 20 was a direct reaction to the announcement of the offering price being set at $4, which was a significant discount to the then current market price. But notice the volume. We saw nearly 90 million shares trade hands in a single day, which is several times the average daily volume. This was not just retail panic, it was a massive repositioning of capital. While retail was selling the news of the dilution, institutional buyers were stepping in to absorb those shares at the $4 level. The fact that the stock is currently trading below that offering price suggests we are in a period of temporary price discovery, where the short side of the market is testing the resolve of these new institutional holders. Recent developments show a company that is aggressively shifting its revenue model. On January 13th, management updated their 2026 guidance, forecasting roughly $350 million in revenue for the full year. To put that in perspective, that represents nearly 10 times year-over-year growth compared to 2025. They also confirmed an exit run rate of at least $500 million in annual recurring revenue by the end of 2026. This is where the tension lies. The market is effectively calling their bluff. If Rezolve hits those numbers, the current market capitalization of just over $1 billion looks remarkably cheap, potentially trading at less than 3 times forward sales. If they miss, the downside is significant. This massive gap between management's projections and the current stock price is exactly why the volatility is so extreme. Trading volume over the last 5 days has been nothing short of explosive. We are seeing a high level of churn as the stock moves from weaker hands to more concentrated institutional positions. The institutional buying behavior here is particularly interesting because it followed a strong showing at the NRF 2026 conference in early January. At that event, the company demonstrated its Brain Commerce platform, which uses a proprietary large language model to handle retail transactions. This isn't just a chatbot, it is a system designed to act as an agent that can complete purchases without the user ever leaving the interface. This shift toward agentic commerce is what caught the eye of the institutional investors who anchored the recent financing.
Institutional positioning is a double-edged sword here. While we see some long-term holders adding, we also have significant pressure from firms looking to lock in profits or hedge their positions. Short selling is a major factor in the RZLV story right now. According to the latest exchange data, short interest is sitting at roughly 24.66% of the float. That is an incredibly high number that indicates a massive bet against the company's ability to execute on its 2026 guidance. With approximately 29.28 million shares sold short, the days-to-cover ratio remains relatively low due to the high daily trading volume, but the pressure is undeniable. The short thesis is largely built on 2 pillars: management credibility and the nature of the company's growth. Skeptics point to the leadership of Dan Wagner and a history of restructuring that has made some investors uneasy. There is also a concern that the growth is being bought through acquisitions, like the recent deal for Crown Peak, rather than being generated organically. Short sellers believe that the high revenue projections are aggressive and that the company will eventually run back to the market for even more capital, further diluting shareholders. On the other side of the trade, the bull case rests on the idea that the proprietary technology stack is unique enough to capture a large slice of the e-commerce infrastructure market. They argue that the high short interest is actually fuel for a potential squeeze if the company reports even a single quarter of better than expected organic growth. Retail investors need to interpret this short data carefully. A high short interest percentage does not automatically mean a squeeze is coming. Often, stocks are heavily shorted for valid reasons, related to liquidity or fundamental weakness. However, when you see a stock with 25% short interest receive a $250 million cash infusion from institutional players, it creates a situation where the shorts could be trapped if the company uses that capital for a significant acquisition or a major partnership announcement. The borrow rates for RZLV have shown some spikes recently, which is a key indicator to watch. If the cost to borrow shares continues to rise, it could force some of the smaller short positions to cover, creating a cascading effect on the price. Retail sentiment is currently split down the middle. If you look at the discussions on Reddit, particularly in forums like The Race to 10 Million or Wall Street Bets, there is a loud contingent of traders who see this as a high-risk, high-reward play that is being unfairly targeted by short reports. There are frequent calls for transparency and questions about the timing of the recent price drops. At the same time, more conservative, value-oriented forums are warning that the negative operating margins and the pace of share issuance make this a dangerous environment for anyone without a high risk tolerance. It is essential to recognize that while retail volume can move the needle on a small-cap stock, the ultimate direction of RZLV will be decided by whether management can prove their $500 million annual recurring revenue target is achievable. Comment how many shares you currently hold, and let me know your thoughts on the recent dilution versus the institutional oversubscription. This kind of engagement in the comments helps everyone get a better sense of the actual retail positioning versus the institutional data we see in the filings. Rezolve's business model is built around its Brain commerce platform and its proprietary Brain Power large language model. Unlike many companies that simply skin existing models like GPT, Rezolve has focused on a foundational model specifically for the retail and e-commerce sectors. Their goal is to improve conversion rates and reduce cart abandonment by making the search and discovery process more intuitive. They generate revenue primarily through cloud-based services across the United States, United Kingdom, and Mexico. While the potential for this technology is high, the company is still a significant distance from consistent profitability, having reported a net loss of nearly $29 million in a previous quarter. Looking ahead, there are several possible scenarios for the stock. In the bullish scenario, the company uses its new $250 million war chest to acquire a direct competitor or a complementary technology that instantly boosts its organic growth rate. If they can show the market that they are on track to hit that $350 million revenue target for 2026, we could see a rapid revaluation toward the $7 to $10 range, especially if short sellers are forced to cover. The upcoming earnings report in April will be a major catalyst. Any update on the SQD network revenue model or new enterprise deployments could serve as the trigger for a major move.
In the bearish scenario, the company continues to burn through cash while the integration of its recent acquisitions proves more difficult than expected. If revenue growth stalls or if another leadership shakeup occurs, the stock could easily test the $2.00 level that some short sellers are targeting. The risk of further dilution remains a constant shadow over the stock. Even though they just raised $250 million, a company with an aggressive acquisition strategy can go through capital quickly. Investors should be watching the burn rate and the transparency of their organic versus inorganic growth figures. To summarize the core insights, Rezolve AI is currently a battleground stock, defined by an extreme gap between its current market price and its projected 2026 performance. The reality of the recent financing is that it provides a massive layer of protection that many small caps simply do not have, but it came at the cost of significant dilution that has dampened immediate sentiment. The expectations for 10 times revenue growth are high, and the market is currently pricing in a high probability of a miss. However, the high short interest and institutional backstop suggest that the story is far from over. Expectations were for a smooth ride after the NRF conference, but the reality has been a brutal lesson in market mechanics and the cost of raising capital. As we head into the next several months, the focus will remain on whether those ambitious revenue targets are a reflection of actual enterprise demand or just an optimistic forecast. Rezolve remains a high-stakes experiment in agentic commerce that will either reward the patient institutional holders or serve as a cautionary tale about the risks of aggressive growth projections in a volatile market. The choice for investors now is to decide if they trust the institutional conviction or the short seller skepticism. Always keep an eye on the borrow rates and the volume patterns to spot abnormal behavior before it hits the headlines. Stand by your strategy and manage your risk accordingly.